Hello and welcome to this very special edition. We thought, considering we're kickstarting earnings officially now, so let's get an in-depth analysis going on what to expect from each and every sector and what to expect from the earnings season per se. Though optically this quarter, numbers may look good because we've got the base effect in our favor.
A very large base effect because same time last year, the metal space was bombed out. PSU banks were forced to take extra write-offs on their balance sheet. Some of them actually reported a fat loss also. That will be different. I expect a little bit of recovery which would have kicked in the cyclical space. IT is going to be down, but net-net if I look at large sectors like PSU banks, metals, road sector, little bit of improvement in consumption because of inflation and other demand factor, we could be in for a big earning number per se. But the question is, are we in for a very strong operational improvement in all the companies? That's where I have my reservations.
Yeah, and that's just one part of it, the earnings. The or rather the second part of it is the fact that the market has gone in extremely high into this earnings season. So we're already staring at all-time highs for ourselves. And that is the only aberration, right? That if there is any disappointment coming in, is the scope for disappointment in the market then larger? Are we going to see huge cracks coming in, or do you think the market will be able to take it in stride, an inline set of earnings?
Ayesha, the way I look at things is that because of demonetization, the Q3 earning season, the Q3 earning expectations were very ordinary, were very low. And ordinary numbers, they also looked good. This time around, it's the other end of the spectrum. Expectations are very high and ordinary numbers may not really do the trick for markets. In fact, we more than number meet, we need a lot of number beats for market to really sustain higher markets. By the end of Q4, they need to get convinced that not only earnings have bottomed out, but a fresh cycle has started. But remember, this time the earnings season is not going to be very compressed because this is the Q4, so the numbers will keep on coming out till May end. So to judge just based on the initial 10-15 numbers to understand what lies ahead for FY18 would be difficult because this time the earnings season would be a long. In fact, I expect the Tata group of companies to come out with numbers only in May middle or by first week of May. So that's the difference.
Yeah, this is going to be a long and stretched earnings season, this one. In fact, over the next 1 hour, we're going to analyze, pick up each and every sector, bring in our research analysts as well and try and understand what within sectors could hold out, where is there scope for improvement, disappointment, what have you. Of course, we've got 3 experts as well to analyze all the nitty-gritties of the earnings season and what to expect. So on board with us today, Shibani Sircar Kurian, the Vice President and Head of Equity Research at Kotak Mutual Fund. Also got on board Dhirendra Tiwari, Head of Research at Antique Stock Broking. And then, of course, our very own Sandip Sabharwal from sandipsabharwal.com as well to analyze the earnings and what to expect thereof. Also got on board our entire research team who's waiting by with every sector that they track, and 6 of them in line. But Darshan, I'm going to come to you first to talk about what is the overall expectation from this time around in the earnings.
We've taken views from the earlier brokerages that have come out with the earnings season report to get a flavor of what they believe the season will be. First of all, Antique believe that in their coverage, the PAT will rise close to 30%. They believe that the PSU banks will be something that will be driving earnings this time around. They are saying counters like the PSU bank, industrials as well as auto, they are likely to have a decent quarter this time around. While for oil and IT, it will be a slightly moderate quarter. Citi believes that there could be a 20% growth on the 4th quarter on a low base, especially in banks as well as metal counters. Domestic cyclicals will continue to show a recovery trend. Auto and telecom, they believe that the weakness will persist, but there will be recovery as far as staples is concerned post demonetization. Strong quarter for financials, materials and consumer staples, while it will be a weak quarter for telecom, IT, capital goods as well as healthcare. Deutsche Bank believes that the low base effect will actually help to propel the growth as far as the Sensex companies is concerned. Autos will be the biggest drag as far as the sectors are concerned. Banks, energy and FMCG will post a double-digit growth, while telecom, auto and exporters will lead to a drag as far as earnings is concerned. And finally, Edelweiss is saying that they expect the top line growth to be close to 17% for their coverage universe. They believe that PSU banks and NBFC as well as industrial companies will report double-digit earning growth this time around.
Okay, so I'll throw that basic assessment at Dhirendra. Dhirendra, what is your sense? I mean, optically, the base effect will make the earnings season look good, but operationally, nothing much is expected.
I guess there will be some improvement according to our numbers, excluding the one-off kind of effect because of PSU banks, etc. Still, there will be about close to 12% earnings growth. So I think this is going to be a decent quarter, primarily because of the fact that we believe that overall discretionary demand has been pretty decent, and therefore companies which are catering to discretionary demand will post decent growth, and therefore we think that autos or paints or consumer electricals, air conditioners, those kind of companies will do pretty well. A lot of these are basically not nifty companies, but still they will do pretty well, and that's why we think that the whole space will do much better than what it was earlier expected. I also believe that there is a reasonable strong growth in the private sector banks, and there is a reasonably strong growth in industrial companies. So I would assume that if you see last quarter also, for the companies under our coverage, there was about 30% growth, again because of base effect, but then there was a reasonable performance by many companies within various sectors, which was quite surprising. So I think it is going to be a healthy quarter. It is not going to be operationally disappointing quarter in my sense.
Shibani, what is it that you're penciling in terms of an EPS estimate for the Nifty 50 companies?
So when we're looking at the quarter, clearly we are looking at a quarter with kind of a double-digit growth in terms of overall earnings. However, as you guys were mentioning earlier, a lot of the earnings growth is coming in because of a low base effect in two sectors, which is on the PSU bank side as well as in terms of commodities. I think when we look at this quarter, it is important because couple of things. One is it sets the base in terms of expectations for FI for the next year, FY18, in terms of what earnings people will be penciling in. Secondly, also it is also a quarter where the full impact, it's one full quarter post demonetization, and numbers will possibly show how the pace of remonetization has been and how fast the recovery is taking place in terms of demand improvement in the system. And I think then that's what will set the tone overall for the quarter as a whole. Clearly, domestic companies and companies with consumer discretionary focused companies will possibly see some improvement in the quarter, and that is something that we need to watch out for, especially given the fact that for next year we are expecting better numbers both in terms of growth for the economy as a whole as well as for corporate earnings. So I think this quarter is important because it sets the tone and the pace for the outlook for next year, and that's what is possibly going to be driving valuations incrementally. Clearly, corporate earnings needs to be the key factor from here on, and that's what is going to be the driver for the markets going ahead.
Sandip, how much of the current construct, which is base effect and the fact that earning will be better than Q3 is already in the price?
I would think that when we are comparing the markets, actually we are comparing them off a base also. That base was also very bad in one sense that like we were discussing before the show, that some of the metal companies are actually making losses in that quarter, banks are making losses. Most of the capital good infrastructure companies were just coming out of the doldrums. So the figures for this quarter will look good to that extent. But then I think the way to analyze in my view would be that where the expectations are too high and where expectations are too low, and that will determine how stock prices of various sectors as well as specific stocks will behave. And then there is a set of companies where current earnings won't matter so much, the future outlook would be more important. For example, something like Reliance is not moving on what the current earnings will be. It's moving on what Jio could potentially do, there's speculation around retail listing, etc. Similarly, most of the capital good infrastructure companies are moving more on what the order accretion will be. Most of the banks are on the wholesale banking or PSU banking space would be moving on what potentially could happen next year rather than what has happened in the last 1 year. So I think markets are forward looking and they are looking at improvements in a lot of these segments and sectors, and that's the reason you see why markets are here. I would think that very few stocks or sectors will react very violently to results this time. So I think and the entire result season actually might also end up sometime in a phase where globally markets could start correcting sometime in May, June. So the attribution could happen to the results. So I think this will be a somewhat complex result season.
Okay, a take on the market psychology per se, but Sandip did touch upon the fact that it's going to be a very placid earnings season with placid reactions coming in. And the one space wherein expectations are extremely low has got to be IT. So Sunita from our research desk joins in to tell us what to expect from IT and telecom being the other one. Sunita?
Q4 is a seasonally weak quarter for IT companies, and this is also a quarter where rupee has appreciated by 4.5% versus dollar. So these are the two things that the companies have to deal with as far as Q4 numbers are concerned. Organic growth for tier 1 companies is expected from 0 to 1.5% in this quarter. Margins will be lower largely because of the moderate revenue growth they are likely to clock, plus the rupee appreciation will shave off some of the margins in this quarter. Coming to company specific, as far as Infosys is concerned, focus will be on the guidance. After 3 revisions they've done in the guidance for FY17, analysts are expecting them to be conservative and expecting them to guide 7 to 9% constant currency growth. Another expectation from Infosys is the buyback. The company is sitting on $4.5 billion worth of cash on their books, and the analysts are expecting them to announce $1.8 to $2 billion worth of buyback in this quarter. TCS will be a stable quarter. Focus will be on the commentary of the CEO, what they are expecting in FY18. HCL Tech will be a strong set of numbers. We are expecting them to clock 4.5% growth, including the acquisitions they've made, and also we are expecting them to give a strong guidance of for FY18 of 10 to 12% in constant currency. So these are the expectations from IT companies. Q4 will be weak, but the focus will be on what they guide for FY18.
DT, the IT numbers are likely to be weak. Now, IT stocks have been underperforming, a buyback has already kicked in. Do you think somewhere IT stocks may actually surprise along with their earnings season if there is a little bit of positive tinge to the commentary? Dhirendra, question was for you.
Oh, it's for me. I'm sorry. Now, actually, very important point that your analyst has already highlighted. Important thing is this quarter everyone knows is going to be disappointing, and that is there in the price. Now, important thing also to notice is that what happens in FY18. To me, it looks like a challenging year to IT sector as a whole, and challenging in the context of some sort of slowdown overall, and also the double whammy is also in terms of rupee appreciation, and therefore the profitability will further get impacted. Now, in that context, everyone agrees that these are great companies and they have very strong returns. ROEs and ROCs are extremely good. They have cash on their books. But important thing again comes to mind is that if you are growing at less than 5%, it is very difficult for us to go really very strong on the sector. So my view is that we have maintained a neutral view on IT sector for some time, and by virtue of being a large heavyweight sector, one has to go for a few IT stocks. The best case, of course, is Infosys, and therefore I would assume that there is not much of excitement for the time being, at least for next 2 quarters for the IT sector. If one has to really look for some kind of bounce back in case of some sort of earnings surprise happens, it could be Infosys. HCL Tech, everyone knows, probably is the company which is going to do well. So my risk reward will be little more on IT, within the IT sector will be Infosys. But as a sector, we are looking a little cautious on the sector and maybe having a neutral view on the sector as a whole.
Okay, in fact, let's bring on board Poonam as well to tell us in detail about what to expect from the BFSI segment per se.
Well, Q4 should see better profits for banks. Having said that, these would be coming in on account for weaker, based on account of AQR in the same quarter last year, but expect relatively weaker credit growth as well as weaker treasury gains. But on the other hand, margins should be stable, and also we should be seeing some amount of moderation in incremental slippages for most of the banks. In fact, Yes Bank, IndusInd, Kotak, HDFC Bank will report stronger earnings. For ICICI Bank, profits would be higher on a weaker base, but also there is a possibility of slight improvement, a marginal improvement in the asset quality. Guidance remains very much important on asset quality, and even for Axis Bank, asset quality guidance would be most watched out for. For Canara Bank, they should be seeing some amount of stake sale gains on account of stake sale in Canfin Homes, and similarly Union Bank would be seeing some amount of stake sale gains in Sibyl as well. In terms of the NBFCs, Q4 is traditionally a strong quarter for NBFCs as well as mortgage financiers. In fact, HDFC Limited, LIC Housing Finance should see stronger earnings. Q4 would be stronger for Mahindra and Mahindra Finance, but may see some seasonal dip in NPAs. Shriram Transport Finance may see slightly higher NPAs on account of shift to 120 DPD. Stronger collections for Chola Finance are likely. Bajaj Finance and Capital First are likely to report an earnings CAGR of earnings growth of nearly around 34 to 38%. Manappuram Finance is likely to report stronger profits. L&T Finance may watch out for recoveries there, and PFC REC is also likely to report stronger earnings during this quarter. So for quite a few of the entities, we should be seeing stronger earnings both within the banks as well as NBFCs.
And Shibani, you know, I just want to get your views in on what you're expecting from banks, because I guess the base case scenario of the base being extremely low and therefore this optical illusion of a high jump, you know, fits absolutely true for the banking pack, if nothing else.
Yeah, so when you look at the banking sector as a whole, we'll have to look at it possibly in 3 or 4 parts. You know, you were mentioning from PSU banks, the base was low given the asset quality review that took place last year. But when you look at from an industry perspective, credit growth has been extremely muted, and most of the PSU banks will see growth being muted on the credit side during the quarter. I think last quarter they had some kind of you know, treasury profits supporting their core earnings, and that would be absent this quarter as well. I think the overall focus for PSU banks will clearly be on the asset quality side and incremental pace of slippages and recoveries. Slippages may be slightly lower or at least stable vis-a-vis the last quarter, but clearly the issue has been in terms of pace of recovery, especially for large corporate NPLs. And there again, the hope is that the government and the RBI would find some sort of a resolution and come out with a package or some sort of a new methodology in terms of dealing with these NPLs. And I think that is what the market will possibly be focusing on for PSU banks. For private banks, again, we need to look at the retail private banks, and we've been clearly overweight on the retail private banks and the smaller private banks because these are banks which are gaining market share both in terms of loans and deposits, and that is a trend that is likely to continue. The retail space, while has seen some degree of slowdown, but clearly the growth on retail credit is significantly higher than what it is for overall credit growth in the system, and that is what is going to be the key driver for earnings. And here the impact or the negativity vis-a-vis asset quality is also significantly lower, and that we believe will hold on. For private banks on the corporate side, again the focus will be in terms of what is the outlook on the watch list going forward for next year, and also the pace of resolution. So as a pack, I think you know, one would possibly look beyond the base effect in terms of the YOY growth. The more concentration would be in terms of what's happening on asset quality and core profitability for these banks. NBFCs is a wide space where clearly there would be different pockets of NBFCs which would you know, report numbers, and there would be a fair degree of variations in the numbers. I think NBFCs which have an element of consumer discretionary or consumer focused NBFCs would possibly fare better during the quarter. Also, remember, it is a quarter where a number of NBFCs would be transitioning in terms of NPL recognition. So that is also something that could have an impact during the quarter. But typically Q4 again is a seasonally strong quarter for a lot of NBFCs. So I think numbers would be fairly variant for NBFCs. And finally, on insurance, I think that is a space where we have been extremely positive on, and we believe that especially post demonetization, the structural shift that we are seeing towards financial savings is something that will continue, and that will possibly be positive for insurance companies, where flows in terms of new business has been strong, and we expect that the month of March would also have been strong for the sector as a whole. So fairly wide sector with wide variations. I think the focus will clearly be on core profitability, will be on growth and on asset quality.
Okay, let's take a break then on that note, but our researchers Yatin and Sunita are waiting by. Yatin, Sunita, which sector are you going to break down for us after the break?
From demonetization to the Supreme Court verdict on BS3 vehicles, a lot of things that have impacted the earnings for auto companies, and we'll talk about the preview and the expectations from the fourth quarter auto earnings on the other side of the show after this very short break.
Will hyperactive market conditions continue to hurt Bharti Airtel Idea Cellular in Q4 as well? I will tell you after the break.
All right, thanks for staying with us. Q4 earnings season, well, it has started, but the big one of course is Infosys, and we've told you about the broader expectations from what we should expect from Infosys. Auto is one sector where there's a bit of a, it's a tricky sector to call, whereas auto dispatch numbers are being released on a monthly basis. But the volatility in the commodity prices, given last year commodity prices had punctured, this time around there's a revival in commodity prices. For exporting companies like Bajaj Auto, it's not been a great quarter given what's happened to currency. It's a bit of a tricky sector per se. Dhirendra, how would you map the two-wheeler, how would you map the auto space at large? First, can you give us your broad thoughts on two-wheeler versus four-wheeler, and then we'll get into specifics?
Auto, what we have seen in last 2-3 years has been a very remarkably strong story. Now the important point here is that the structurally sustained opportunity which we have seen in four-wheeler companies like Maruti will continue. So in my opinion, given the profile of the company and given the latent demand in the economy, Maruti, despite being one of the strongest earnings outperformer as well as stock outperformer, will continue to do that. So, if one looks at four-wheeler versus two-wheeler, definitely preference goes to four-wheelers. Now coming to two-wheelers, there is some bit of differentiation. Our preference has been to high end of the two-wheeler market, which is represented through Ayesha. See, if one looks at the performance in last 2-3 years and in recent quarters also, when the full impact of demonetization was being felt, the company continues to chug along pretty nicely. So I guess there is a huge opportunity within the two-wheeler space, more so for the upper end of the market, and therefore I would assume that Ayesha is equally strong contender to be on the top slot with Maruti in that space. Coming back to the mass scale two-wheeler companies such as Hero, there could be some challenge in the near term because of demonetization, also because of some bit of inventory that they had, and therefore one can expect a little bit of underperformance there, and that essentially is what we are looking in the near term. So that's where we stand today in terms of passenger cars and two-wheelers. There is little bit of revival expected in the CV space, but then again it is the space which is yet to really unfold the growth that we have talked about. And two companies that we have today, Tata Motors and Ashok Leyland. Tata Motors is more a Jaguar play than a CV story today, and there we have a buy rating as of now, and we continue to maintain that Tata Motor remains a reasonable play within that space. So that is where we presently stand as far as auto space is concerned. Preference for Maruti Suzuki and Ayesha, and have a liking for Tata Motors as well. And then we have a whole host of auto ANGs where we have some bit of divergent opportunities, and there are stocks which are worth betting on in that space also.
Okay, let's go across to Yatin from our research desk and try and figure out what the ET Now estimates are when it comes to auto as well as auto ancillaries. Yatin, what is your poll penciling in?
As I was speaking earlier, we have the entire BS3 issue as well as demonetization, which has impacted the overall auto sector earnings. Of course, talking about the fourth quarter earnings in specific, Hero MotoCorp is something you need to watch out for. A lot of BS3 inventory, and a lot of that got sold at a 15 to 20% discount to the regular selling prices, and probably that is the reason why we could see some margin pressure. Bajaj Auto also, if you talk about it, no BS3 inventory, but the export markets continue to be a drag because the overall performance has been hampered. Volumes are low because of geopolitical conditions in the countries in which they export. In the commercial vehicle space, again the discounting was high. In the commercial vehicle space for Ashok Leyland and M&M, probably the discount per truck was as high as 4 lakh rupees per unit, and probably because of which the margins could be very low, especially for Ashok Leyland, which has a large BS3 inventory. Talking about four-wheelers and Maruti in specific, no BS3 inventory, but still if you talk about the cost pressures that are there because of rising commodity prices, and also they have started the Gujarat plant, so the depreciation and other overhead expenses would be higher probably in the fourth quarter. And finally, talking about the auto ancillary space, watch out for Bharat Forge and Motherson Sumi. On an overall basis, we have seen uptick in the European markets and the US markets, and the outlook there also remains strong. So in that light, we could see some improvement in earnings and positive management commentary. And taking on on all these things into account, probably we have seen some share price move which has come in most of these stocks, but the margin performance for all of these two-wheeler and commercial vehicle players is something we'll be watching out for in the fourth quarter earnings.
Okay, interesting moves within the autos, and you can't really draw the same parallel for the entire auto space. Sandeep, what is your view? Because, I mean, one's got to treat the four-wheeler space differently, two-wheelers now with the BS4 norms coming in differently, and then auto ancillaries like tires, etc. are in their own trajectory.
Yeah, so I think what we'll see is that something like Maruti will continue to deliver strong results despite the raw material pressures because of the premiumization, because they are selling more higher value products. Two-wheeler will obviously be under pressure, but I think going into the future, looking into the future, I think one of the big reasons why Bajaj Auto suffered on the export side was the oil price crash. So if oil prices are coming back, we could see that market coming back for them next year. And to that extent, they would be starting off the year on a decent footing. I would think that Tata Motors could be interesting because last quarter results were disastrous. This quarter overseas numbers for Tata Motors have been pretty interesting, and I think this will be an interesting result to watch. And I think they could actually surprise on the upside, and the stock's been languishing in a very tight range. So I think that could be one stock which could actually see some result reaction. M&M again would be a stock where tractors have done very well. The analyst expectations are very low in terms of M&M expectations. So I think that's another stock which could surprise. CVs, nothing much should happen. But I think among the auto ancillaries could do better because export markets have done better. If you see sales, global sales have been much better off. So some of the exporting auto ancillaries could do much better.
Oh yes, global sales have been on the mend, and we've seen that with the US Class 8 truck orders, etc. as well trickling in by. Shibani, what is your own view on what could actually outperform within the auto sector?
I think auto has been a sector where we've been structurally very positive. While in the near term for this particular quarter, like you said, there could be divergent trends across categories. This is also a quarter post demonetization where we will have to see how, for instance, on the two-wheeler segment, the volume recovery takes place. There will be some amount of margin impact in the quarter because of higher commodity prices and also the discounting that has happened prior to the emission norm changes. But I think in this sector, clearly on the passenger vehicle side, we continue to remain very positive, and this is a reflection of consumption and the consumer demand story overall for the economy as a whole, and that is a space where we remain positive. On the two-wheeler, we expect to see that there would be revival as we go into next year. In fact, if you look at volumes, the trend seems to be stabilizing, though they have not really picked up as such post demonetization, but trends are that on the two-wheeler side, volumes could be stabilizing. One factor to note would of course be monsoons and how the rural economy recovers, and if the monsoons are decent and more or less normal this year, and there is a pickup on the rural space as well, there could be an improvement overall for the sector as a whole. So far it has been more on the urban side where passenger vehicles have been driving the growth and the overall trend in the sector. But structurally, I think that this could be a sector that could remain where we remain fairly positive on, and we need to look beyond just this quarter and look into trends going into next year as well.
Now, before I go to Sunita and talk about telecom, let's talk about Reliance, because Reliance for the quarter gone by has really been on a vertical tear, so to speak. And Sandip, I don't know which category to classify Reliance in now. I mean, I know it is still a petrochemical company. They have interest in oil and exploration, but for the quarter gone by, they were riding the geo wave.
Yeah, so I think they were riding the geo wave, and the future directional move of Reliance also is based on what Jio does. The refining business is well researched, petrochemical business well researched. There are very few surprises which can come out of those businesses. Where they could actually throw up surprises is on the Jio front and on the retail front, because retail, their size has become very big. It's not been very profitable. So if they do something to improve profitability, given the buzz on the retailing side, we could see that also get that attribution into the value come in. But the speculation of people that they'll do a separate listing, I don't think Reliance is going to do separate listing of any company. I think it will just remain one company, and that should not be the expectation. So I think Reliance is a Jio story for now and for the foreseeable future.
Oh yeah, for sure. In fact, that 27% meteoric rise that you've seen in Reliance, now that it's a 9-year high for the stock, that's all got to do with Reliance Jio. But Dhirendra, what is your own expectation? Because clearly the telecom sector seems to be dictated by what Jio is going to do, and the bit of a relief as well that has come in off late in at least the stock price reactions has been purely because of the fact that TRAI came out and said that asked Reliance to roll back their summer surprise offer. But earnings wise for the quarter gone by, what is it that you're penciling in?
Reliance has done reasonably okay as far as earnings are concerned, with very strong GRMs over last several quarters. So it is not which is going to be a meaningful disappointment or any kind. But having said that, Reliance has been a very case study kind of stock, and as we have seen for last 8-9 years, the stock has, except for last 2 years, has virtually been underperforming all the time. Now, slowly and steadily, it has become one of the best performing stock in FY17, though on the back of last 2-3 months of outperformance. So it is to be seen. Our overall view on the stock has been positive. Earnings have been pretty decent in last 4-5 quarters, and the whole discussion has moved on to telecom and Jio, etc. And therefore, one has to really figure out how next 3-4 years the telecom business will pan out. The stock will accordingly behave. So, at this point in time, we seem to be hitting as far as our target valuations are concerned. So, we are not in a really position to say outright buy, but then it is a stock which I think will remain interesting for the year to come.
Sunita, you tell us, what is it that you're pricing in terms of telecom earnings?
Jio's free offerings will continue to hurt the sector, and both Bharti Airtel and Idea Cellular will continue to see pressure. As far as voice realization are concerned, they are likely to slip in this quarter, and the incoming calls are making, although the volumes are going to increase, but the voice revenues are likely to decline in this quarter. Even the data revenues will be lower, and largely because data realization are coming off as Reliance, as the traffic is shifting to Reliance Jio. Bharti is expected to declare 6% decline in their wireless revenues in this quarter. As far as Idea is concerned, they're likely to post a loss of 900 crores in this quarter that we are expecting, while Bharti Infratel and Tata Communication will see strong quarter in this in Q4. So both the companies are likely to post strong numbers, while for Bharti Airtel and Idea Cellular, it will continue to be a pressure coming from Jio.
Okay. Shibani, is there any hope for telecom companies for the quarter gone by, or what we saw in Q3, which was, you know, pressure on margins, pressure on top line, pressure on bottom line, that trend is likely to continue?
I think that trend is likely to continue. So telecom has been one space where we've been negative for a fairly long period of time. And you know, if you look at both the quarter and the immediate future, we continue to remain fairly negative on the space. One thing is that while there has been consolidation, it does not mean that there is going to be any let up in terms of the competition that you're seeing in the space, and that is likely to continue to hurt the quality of earnings and margins going forward. And you know, we've seen that the number one player has become number two, and we have got an incumbent who clearly is very aggressive, and I think that is going to be ruling the dynamics for the space and the sector. So telecom is a space that both from a quarter perspective as well as, you know, in the near term, immediate future, we will continue to remain fairly negative.
Okay, we've covered one part of the Reliance story, that's telecom, but the other one, oil and gas. We're going to take a very quick break, and Ajay from our research desk is waiting by to tell us exactly what he's going to talk about when we come back.
Oil and gas stocks are in focus, with Reliance actually making fresh 9-year high. We'll talk about what to expect from Reliance, oil marketing companies and gas stocks, all of those after this very short break.
Alright, thanks for staying with us. Let's go to Ajay now, and he's going to bring our viewers up to speed with what are the expectations for the energy stock oil companies, oil sector for the quarter.
Well, it's going to be a mixed quarter for oil and gas pack for the fourth quarter. Doesn't get much impacted by demonetization, but a lot of stuff happening on the global macro side. Crude oil prices have rebounded on a sequential basis. That's going to lead to some amount of inventory gains for oil marketing companies. Talk of GRMs, $5 to $6 is the range where most oil marketing companies, the PSU ones, will be declaring their GRMs. But it's the Reliance Industries, the big boy, which could have a normal quarter, $10.50 kind of a flat kind of a GRM this time round. But the petchem side could show some improvement. So healthy quarter, but no fireworks because overall GRMs were under check this quarter gone by. Talk of gas stocks and volumes for IGL, Petronet LNG are also expected to be healthy, but more than that, the commentary from them on volume front, because emission is a big issue in NCR, and a lot of there's a lot of transfer to CNG related vehicles happening there. Back in Gujarat, the growth on industrial side is pretty good. Demand from LNG is improving. To Petronet LNG volumes commentary is something to watch out for. So net, it will be a mixed quarter for oil and gas sector.
Mix it's going to be, but going by the stock price action, it doesn't seem to be the case. Sandeep, what is it that you're expecting? Of course, with Reliance, telecom is only one side of the story, but what about the OMC lot and the expectation there? Do you think all the good is already baked into the prices?
See, the driver for the PSU oil marketing companies, the OMCs, is hardly what the results they report. I think it's more to do with the kind of reforms which are happening in the sector. And we talked a few days back that this daily pricing of fuel as it comes in, the kerosene sale volumes steadily falling and likely to be eliminated over in the next few quarters. I think all these are very positive signs for the OMCs. And in terms of pure valuations, the stocks are not so expensive even now, even after the kind of 200% up move they have seen over the last few years. So I would think that these are reform led and they will continue to perform. as they generate significant cash flows going forward.
Shibani, you're not expecting the downstream energy companies to witness extremely strong numbers. Why is that the case? Shibani?
Yeah, hi. Yeah, I heard. Yeah. So oil and gas is a space where I think from a quarter perspective, I think that it will be nothing great as such. But I think oil and gas as a sector, we've been positive on, and we are structurally positive on the sector. While refining margins might be muted in the quarter, we think that if you look a little ahead of the quarter, margins would be stable to improving. Secondly, for the sector as a whole, when you're looking at the kind of reforms and subsidy reforms that are taking place, that is structurally a positive. And valuations for oil marketing companies are, especially when you look at it from a global perspective, continue to remain fairly attractive. So I think from an overall OMC space, we continue to be fairly structurally positive, and oil and gas is a space where we are considerably overweight. While this quarter per se, I think across for the sector as a whole, we do not expect to see anything meaningful in terms of a strong upside or a strong positive surprise as such, given the way oil prices have moved. And this is a sector where I think if you look at from a slightly longer term horizon, we continue to remain positive.
Dhirendra, is there a strong re-rating scope for oil marketing companies based on the fact that last time they had an inventory loss, this time they may have an inventory gain, refinery margins also have stabilized. We always tend to look at the fuel retailing business of oil marketing companies, but the other businesses also are picking up now.
Yes, if you look at the quarter per se, there could be the case of better performance by upstream companies also, because of the oil prices. Having said that, it is only in last maybe 6-7 quarters in the history of last 20-25 years we have started seeing stable earnings environment for oil refining companies. That is a very important development, and today we really are not really bothered about daily move in the retail prices, etc. Now we have seen several sectors going through the process of re-rating. Couple of years ago, it was very difficult for an analyst to even believe that BPCL or HPCL can even trade at 10 times PE. But my argument is that if you see structural positive growth, and if you see 15 or 12% earnings compounding in next 4-5 years, why would these companies continue to trade at a significant discount to the broad market? It is not going to happen. So our belief is that just like it has happened in many sectors in the past, as we see stability in earnings based on various reforms that the government has initiated, these stocks are bound to get re-rated, and the gap that is there between the market and oil refiners will narrow down, and it has been a process which started about a couple of years ago or 2.5 years ago, and will continue to be in the future also. So I fully agree that there is a serious case for re-rating of oil refiners. Just to put a point here, companies like IGL, say for example, may be trading at 20 times. Now nobody would have given them 10 times, 12 times PE multiple about 18 months ago. But given the fact that the volume outlook for these companies is looking so strong on a long-term basis, the re-rating has been so spectacular that it is almost unbelievable. So my belief is that the same process is going to unfold in oil refinery companies. May not be to that extent, but definitely it is on the card, and therefore we continue to like oil refiners. There could be trading based buying and selling, and therefore underperformance, outperformance on a short term basis. But if you look at 1 to 2 years kind of horizon, I think the oil refiners are here to stay, and they will continue to do pretty well.
Well, FMCG is going to be the other leg, which is going to be very interesting to look out for. Of course, you know, there are the likes of ITC, wherein it's expected that perhaps categories like cigarette will outperform, and that volume tailwind that was impacting ITC for a while is going to be finally negated this time around. There also have been select price hikes that some of these FMCG companies, pure play ones at that, have undertaken in the quarter gone by. But that doesn't seem like that's going to impact volumes much for them. Sandip, your quick take on what to expect from FMCG in terms of earnings.
I think in terms of actual delivered earnings, I don't think they'll be very great. So I think because of the impending implementation of GST, etc., I don't think that entire supply chain replenishment would have happened, which actually took a hit because of demonetization. So I think so some of the food like Britannia could still do well. I think they could still deliver because of what their strategy is. But I think rest of them will report muted numbers for this quarter.
Okay, Shibani, give me maybe a theme or an idea or a clan where you think we are in for a big result surprise. Even though markets are strong, you expect that there could be scope for P re-rating and earnings re-rating along with the Q4 numbers.
Sorry, I didn't get your question.
No, where do you think there is scope? Where do you think there is scope for some earnings re-rating in this market?
No, I think that we're going into this quarter. Clearly, the sectors that would possibly or could maybe lead to some sort of an earnings surprise could be sectors which have underlying domestic consumption themes. I think few sectors that one needs to watch out for is where the theme which is playing out is in terms of the shift from the unorganized to the organized space. That theme has started playing out post demonetization, and we expect that the theme would get strengthened after the implementation of GST. So segments such as building materials, for instance, would be key segments to watch out for, which got impacted significantly after demonetization. But we've also started seeing the kind of shift that we are seeing in terms of market share away from the unorganized space to the organized space. I think that would be one key area which one needs to watch out for, and could lead to some amount of earnings surprises on the positive side. Overall, I think even when you're talking about consumption, while consumer staples will have a muted quarter in terms of volume growth, but consumer discretionary spend and consumer durables, the trends have been fairly positive. The onset of summer and the heat wave was also leading to positive news flows in terms of the growth that you are seeing on the consumer durables front. I think that is also going to be a segment that one could possibly watch out for. And within banks, I think private sector retail banks, and especially some of the smaller private sector banks, which can really outperform in terms of the growth on the loan book. When market is showing an industry is growing at 5%, if these banks are able to grow at a significantly faster pace, I think those are the few key sectors to watch out for overall. So in terms of the construct, when we are looking at the market as a whole, the disappointments would possibly come in from sectors which have global linkages. Clearly IT and pharma to some extent would show muted numbers, and I think that is something one is fairly negative about and watchful in terms of what is the future outlook going to be. But the domestic play, especially on terms of the urban domestic consumption demand, I think would remain strong, and the earnings growth would possibly could throw up some surprises in certain pockets within that space.
Okay, Dhirendra, Shibani, as well as Sandip, thank you so much, all three of you, for analyzing what to expect from this time around's earnings. Largely, a muted earnings set is what we're expecting, at least optically. Or actually, optically, we're expecting a strong earnings set, but operationally, it's going to be a little muted.
Yeah, it will be one of those quarters where you can't look at the number or the first flash and react. Because the first flash in a lot of cases would be a function of base effect and the extraordinary items which would have kicked in. But I'm hoping that we'll get some surprise from cyclicals. I'm hoping that we'll get some surprise from autos and consumers. I'm not expecting any big surprise from pharma and IT, because this earnings season is important because the market setup is that we cannot afford another poor quarter of earnings season, because expectations are high, and for markets to sustain these levels, we need that booster shot.
Okay, on that note, we're going to wrap it up on this very special edition of the earnings quarter.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.